Hello everyone. I'm Wang Qian, the option analyst from the research department of Nanhua. Thanks for inviting me today, and I'm about to give a brief presentation on the introduction of the new listed crude oil option contract, and I'm gonna give a few information on the market outlook for the future. So let's start with the introduction of the contract details. INE crude oil futures contract was listed on March 26, 2018, as we know, about 3 more years ago. And in this year, after the pandemic, the crude oil option contract was listed on June 21st. The crude oil option has the same operating platform. It is listed by INE, so it has the same operating platform and same settlement, same trading and risk management rules as underlying INE crude oil futures. So to be brief, the crude oil option is established on the basis of crude oil futures. That's why we can trust the professionalism of it. So it is the first INE option product which is priced in RMB, in yuan, and so domestic and overseas investors can both trade and trade it. Okay, the graph that shows on the screen is the detailed contract of the option. So let's just quickly go through it. The underlying asset is INE crude oil futures contract, and contract type includes call and put option. Price quotation is by yuan per barrel. The next row which I highlight here is minimum price fluctuation, which is 0.05 yuan per barrel. So here I want to give some explanation of minimum price fluctuation number. The quantitative relationship between option and its underlying futures is delta, as we know. So when we design the contract, the ratio of option minimum price fluctuation to that of futures should coordinate with their quantitative relationship. I can give you a few information that outside of China, both NYMEX WTI crude oil option and ICE, the Brent crude oil option, have a minimum price fluctuation of 0.01 US dollars per barrel. So it is the same as their underlying futures. Here in China, generally, the minimum price for fluctuation of an option contract is half of its underlying futures or less. But considering the liquidity of at the money options and domestic overseas conditions and transaction fees and many other factors, the minimum price fluctuation of INE crude oil options is set to be 0.05 yuan per barrel. While what we need to know that is half of SC contract is 0.1 yuan per barrel. So it is special for investors. If investors want to trade or hedge using the option with a future contract, it is special point that needs to be taken into consideration. So let's just go back to the contract. Um, uh, okay, so the trading hour is from 9 a.m. to 11:30 a.m. In the morning, and from 1:30 p.m. to 3 p.m. in the afternoon, um, and other hours specified by the INE. Okay, so the next highlight point listed contracts. Okay, so the next highlight point, the listed contracts. First, the listed contracts is normally the nearest to consecutive months. It can help investors to manage short-term risks and futures and spot prices to converge. So, and also when the open interest of the underlying futures contract after daily clearing reaches a specific threshold separately announced by INE, the option contract will be listed for later months on the second trading day thereafter. So by linking the listing of option contract with the open interest of the underlying, the number of the option contracts will be kept reasonable to not strain the trading system or dilute liquidity. So to maintain flexibility, INE will separately announce the special threshold. Currently, INE plans for an initial threshold of 10,000 lots in this case, an average of 432 option contracts for 4 contract months, and a highest of 648 contracts for 6 contract months will be listed. The third detail that I want to explain is the last trading day of the option. The expiration day is the same as the last trading day. It is the 13th to last trading day of the month before the delivery month of the underlying SC contract. What we need to know that the last trading day should be neither too near nor too far away from the delivery month. And also options should align its life cycle with underlying as much as possible to function effectively as a risk management tool for the corresponding futures. So since exercising an option converts it into a futures position, the investors should be given enough time to close that futures position. So the expiration date now is kind of reasonable. The fourth point that I want to emphasize is strike price. So first, strike price range is decided by the previous trading day's settlement price of the SC contract, plus or minus 1.5 times the current day's price limit. So it is decided by the previous day's price. And then the strike price interval will be different according to different strike price range. The interval is 2 yuan per barrel if strike price is not larger than 250 yuan per barrel. And it is 5 yuan if the strike is between 250 and 500. So when the strike price is larger than 500 yuan per barrel, then the interval is 10 yuan. Okay, so last, the option style is American option. As we know that the buyer of American option can choose to exercise that the option on the expiration date or the previous trading day. So for our INE crude oil option contract, buyers may submit an exercise request during trading hours on any trading day before the expiration date, and an exercise or abandonment request before 3:30 p.m. on the expiration date. Okay, that's about that is about the contract itself. The next part that I want to share is the crude oil market outlook for the second half of this year. So let's first briefly review what happened in the crude oil market in this year. So in the first half of 2021, under the loose monetary environment, the recovery of crude oil demand is the main logic to drive prices. But now the situation may be changed. So from the perspective of price trend, we divide this year into 5 stages roughly. In the first stage, from January to February, the Saudi Arabia's excess production reduction of 1 million barrels per day has laid a foundation for elevating excess supply and maintaining the stable promotion of OPEC plus production reduction. In this stage, as we can see that the WTI crude oil rose from $50 per barrel to $65 per barrel, and here the Brent crude oil rose from $51 per barrel to about $68 per barrel. And for phase 2, the second stage, in March, the epidemic situation in Europe worsened and the cities were closed in many places. In many places. Thus, the risk of market concern about demand increased, and the international crude oil price fell. As we can see here, the WTI crude oil price decreased from about $65 per barrel to about $58 per barrel, and the Brent decreased from 68 to $60 per barrel. So for phase 3, the third stage, is from April to May. Events happened in this stage. So first, the epidemic situation in India continued to deteriorate. Second, the Suez Canal was blocked, and also the U.S. refined oil pipeline was attacked by hackers. So global demand recovered rapidly in this stage, and oil price kind of fluctuated with upward trend. So WTI crude oil rose from about 58 to about 68, and Brent crude oil price rose from about 60 to $69 per barrel. And for the fourth stage, from the end of May to maybe end of June, with the arrival of the seasonal demand peak in summer, the demand recovery is expected to be strong, and the inventory is lower than the 5-year average. So in this stage, the WTI rose from about 62 to 74 US dollars per barrel, and Brent rose from 65 to 75 US dollars per barrel. And for the last stage, the fifth stage, it is from July until now, with a gap between global crude oil supply and demand narrows. The price of crude oil stops increasing and experiences fluctuation. Now it shows kind of downward trend. So here is a look back for this year. Then for the market outlook, let's first focus on the global macro situation. Since the outbreak, the outbreak of the coronavirus epidemic, the loose monetary environment has brought a macro foundation for the rise of oil prices, as we know. So in order to cope with the impact of the epidemic on the economy, the United States stimulated economic growth through loose monetary policy and fiscal policy. So the Fed restarted unlimited QE in the United States in March 2020. And as we can see in the graph, the US M2 monthly growth reached a peak since the new millennium. Now concerns about when the Fed will cut QE have been affecting the crude oil market. As we can find in the July report of US economy, the July job report announced that the economy adds back 943,000 payrolls, with unemployment rate falls to 5.4%. And also the inflation rate shows a higher trend. So for all these statistics, all the statistics show that the possibility of the Fed reducing QE is increasing, is actually increasing. So once Fed cut QE, the interest rates rise and the dollar index strengthened. And as we can see here, the US dollar index is usually negatively correlated with the commodity prices. So the robustness of the dollar index will put pressure on the commodity prices. Okay, then we can take a look at the supply side of crude oil. The OPEC Plus, led by Saudi Arabia and Russia, has been effectively controlled since the reduction agreement that was reached in April 2020. The OPEC Plus has played a very, very important role in elevating the global excess supply of crude oil and supporting the rise of oil price, as we can see the trend here. So by 2021, the OPEC Plus production reduction agreement has entered into this third stage. So due to concerns about the drag of epidemic on demand recovery, the OPEC Plus has maintained a high implementation efficiency of production restriction. So especially in January, here, the affected by the deterioration of the regional epidemic, the supply and demand structure shows signs of reversal, with a supply surplus of about 1 million barrels per day, the first time since last year, since June 2020. And so in January, at the monthly OPEC Plus meeting, the Saudi Arabia decided to reduce production, which not only made up for the excess supply, but also laid a very solid foundation for subsequent OPEC Plus member states to implement the production restriction agreement. So since April, with the recovery of demand, the OPEC Plus has gradually released production, but there has always been a supply and demand gap, laying a foundation for the continuous rising of oil prices for global markets. And that's what's happening until now in this year on the supply side. So from a fundamental point of view, the global crude oil production increased by 1.9 million barrels in July. In this later stage, increase of oil supply is unexpected. So in total, we give a neutral view on the global crude oil supply side. The reason is as follows. First, for the OPEC Plus production restriction alliance, it is in everyone's common interest to maintain oil prices at a high level from the external environment. It is difficult for the US shale oil to grow in the short term, which provides a solid market foundation for OPEC Plus production restriction and price increase. And also, it provides a guarantee for the continuous promotion of OPEC Plus production reduction agreement in the later stage. At present, currently, the global crude oil surplus capacity mainly came from OPEC Plus member countries, led by Saudi Arabia and Russia. So in non-OPEC member countries, the total surplus capacity is 1.59 million barrels per day, mainly from Russia. Based on our calculation, even if the production of other countries is fully restored in the later stage, there's only 300,000 barrels per day surplus capacity, which has little impact on the oil supply. And now the recovery of Russian production has been close to 90%, and the oil price remain a high level. So under the condition that no other production flows into the market, it seems to be the best choice to slow down the growth rate of production and maintain the high crude oil price. At present, Russia has little economic motivation to break the current production the restriction agreement and increase production significantly. So that is for the Russia. Another problem is Iran, who do not need to abide by the agreement. For Iran, the US-Iran negotiations have been advancing. Although there are still differences in many difficulties in many other fields, there's still a high probability of reaching agreement on the Iran nuclear agreement. So now the Iran's crude oil output is 2.45 million barrels per day, and the production capacity of 1.4 million barrels per day remains to be released. If Iran's crude oil returns to the market, it will be extremely important to make up for the current supply gap. At the same time, the Iran's floating storage of about 70 million barrels will also have an impact on the crude oil market in the short term. So in conclusion, it is difficult for the U.S. shale oil production to increase on the large scale in the short term, and also reducing production and stabilizing price is in a common interest of OPEC Plus member states. In later stage, in OPEC Plus surplus capacity will be gradually released, but the overall progress will be orderly, resulting in less oversupply. The biggest uncertainty of its production growth still lies in Iran, and that is our view on the supply side. And for the demand side, given the neutral view of future supply, as I mentioned just now, the price demand depends on whether the demand can meet the expectation. So recently, due to the spread of Delta virus, the number of new infections in the United States and Europe and in Asia has increased sharply, thus caused concerns about the demand. The reduction of crude oil demand in Asia, especially influenced by the outbreak of Delta virus, it is about 1 million barrels per day. So as the spread of Delta virus is still continuing, it is very difficult to restore the demand to the expected demand level of major institutions for this year. And also according to EIA data for last week, the US commercial crude oil inventory decreased by 3.23 million barrels, which is basically consistent with API data. However, the increase in the United States production of 100,000 barrels has increased for 2 consecutive weeks, coupled with the significant increase in the number of drilling rigs for 2 consecutive weeks. The market is worried about the recovery of US production. Seasonally speaking, the June to September is a peak season of gasoline demand in the United States, which is now nearing the end. So according to last week EIA data, gasoline inventory has increased by 696,000 barrels, and the weakening of gasoline consumption in the later stage is bound to have an impact on crude oil demand. So in total, we remain pessimistic about crude oil price for the remaining months of this year. So it is our main point of view. Then in my presentation will be over here. Thank you for listening. If you have any questions, you're welcome to contact me.